Good morning. Welcome to the next version of the Maslow Wealth Barside Chat. As you know, my name is Matt Jakimiak, and I'm the Chief Investment Officer for the firm. And joining me today is Isaac Thompson, our portfolio manager, and I think the guy who does all the work around here. Isaac, how are we doing this morning?
Oh, we're doing great.
Great, great. Well, they didn't come here to listen to us just chat. Let's jump right in. So we've been getting some questions, and we're kind of feeling it as well, about just kind of the general economy. And there's a lot of economic data that the government produces on a monthly, quarterly basis, and is telling us one thing. But we're also, I think there's kind of a general feeling from just the population as a whole about where the economy is, and maybe those aren't congruent. I'd love to hear your thoughts on it.
Yeah, you're absolutely right. We've seen the hard data, the government statistics about the economy, come in strong for 2 or 3 years now. GDP continues to grow at a robust rate. Unemployment has been down. The joblessness indicator continues towards all-time lows. And inflation, while it is still a tick above our target, is steady and holding well within historical ranges. On the flip side, the way people feel about the economy has arguably never been worse. We've seen a steady decline in labor market confidence. We're seeing consumer sentiment near all-time lows. Seemingly any indicator that you look at is showing that Americans do not have confidence in where the economy is. And this mismatch, it's been coined a vibe session, as the hard data is strong, but the vibes are less than, is really a curious puzzle. And I think the punchline is, okay, so who's right? And like any great binary question like that, the answer is probably both, right? The objective statistics continue to show a strong and performing economy, but it's not without its cracks, it's not without its concerns.
Yep. Oh, great. So you've given us a lot of context. I think probably more important for the folks that are tuning in, they really want to know, like, what is that ultimately translated in terms of, performance in financial assets, whether it's equities or bonds or maybe even alternatives. I think that's probably more indicative of what people care about, right?
Yeah, absolutely. And once again, we've seen these assets climb the proverbial wall of worry. The global equity markets are on track to be on up above high teens returns for the third straight year. Credit markets continue to perform, defaults are low, and in many cases going lower. We've seen this across private markets, public markets, across geographies, and it's done so against the backdrop of a very low negative consumer sentiment. So for the past 3 years, all of the sentiment indicators have either been trending lower or hovering around all-time lows, while the markets and these financial assets have performed extremely well. And so I think it comes back to having a rigorous investment process and then maintaining the discipline to stick to that process despite the siren song of, short-term calls, whether they're data-based, vibes-based, or otherwise.
Great. Excellent.
One thing we have seen, and this was kind of made headlines, were a couple large blow-ups in the direct lending market. We're talking First Brands, Tricolor. Can you give us a little more context on what's happening there and how we're thinking about that?
Yeah. So what I will say is bear with me. There's a lot of information to get through here, but I think the first thing that I will say, and I'm sure a lot of people have read the Wall Street Journal articles or seen it on CNBC, realize the news is there to sell papers, to get eyeballs and make money, right? So they're going to sensationalize things. So what we try and do is we try and distill through kind of the noise and get through to, what's important. So let's talk about what, Tricolor and First Brands really is, these are private or direct loans, and compare that to the public space and ultimately, or public versus private, what that ultimately means. So first thing is, when we think about the public market, we refer to it as the BSL, the broadly syndicated market, as you know, and that's public. The difference with these situations, they were private. And so these are direct loans. So think about, most of our clients will know about Blue Owl and Golub. So when I'm thinking of private loans, let's just use that as kind of our proxy. So that's one of the major differences. One is going to be public, one is going to be private. The second is that, people have talked about the market size and has the private market become such a large percentage of the fixed income market that it's a concern? Well, we've actually distilled down the numbers, and interesting to look at. So on the broadly syndicated market, investment grade and high yield, it's somewhere around 11 trillion. The private market's somewhere around 2 trillion. Okay? Relatively, it still sounds like a lot. If we include other things like government debt, munis, and the like, the overall fixed income market is well in excess of $200 trillion. So people have said, oh my gosh, private market on the debt side has gotten way too big, it's a systemic risk. Not really. Really what has happened is that they filled a void after the Frank Dodd Act and the great financial recession in 2008, in that banks were restricted on some of the lending that they could do, so people that needed to borrow capital needed to find alternatives, and in the private market ultimately found a way and started providing capital. Okay, so it's not a systemic risk, at least we don't believe so. We like it, and there's some advantages on the private side because of some of the structural things, the covenants, that ultimately make this really attractive. So if we think about the structural aspects of it, is that on the private side, when a Blue Owl or a Golub originate a loan, they have to hold that loan. They don't go and package it and syndicate it and go sell it, they own it. So they've got financial skin in the game. When a bank like a JP Morgan or a Bank of America originates a loan, what do? They take it, they chop it up, they put it with other loans, they then sell it out in packages, and they don't really care. They have no financial skin in the game. Their economic engine is to just continue to originate. So I look at the private market and I say, well, when Blue Owl does a deal, like they have massive risk because they're owning it. It's their financial well-being, it sits in their funds, it's their reputation. They have to do well. Covenants in this space are a lot higher as well. People would say, well, private markets, they should have less covenants. Absolutely not. Because there's less public access to it, like you need to make sure that there's a way to get your money back out. You make a loan, that loan then has to perform. The tripping covenants, whether it's a technical default or an actual default, like these things actually are present. Some of the public markets, it's very much a standard product. And you don't see much customization because they just really can't do that, because they have to go offer it out to thousands of investors to actually make it work. So there's some protection there. The last, which I think is really interesting, is that if we think about the public market versus the private debt market, on the private side, there's a lot more accountability. I just told you about the skin in the game for the lenders, but most of these are going to be PE-sponsored companies. So now you've got a big private equity company who's given hundreds of millions of dollars, if not billions of dollars to these companies. You don't think that they don't want to get their money back? They absolutely do. So we look at it and we say there's a lot of constituents on the private side who will make sure that there are better outcomes on the private debt side than there are on the public side. Okay? Next point. Defaults are going to happen. It is just the nature of the beast. When you get involved with any risk asset, there is the potential that you could have an adverse, outcome. Debt market is no different. So to think that it's not going to happen is just, I guess, naive. But if we look at historically the way it's worked on the public side, and it's got a longer track record, but we see that default rates on the public side run somewhere around 2 to 3% annually and can flex up to 8% during recessions. On the private lending side or direct lending side, it sits somewhere around 1 to 2%. And over the last 5 to 10 years, it's actually run sub 1%. That to me sounds more attractive. And oh, by the way, we get a better yield. So we like this. Now, you've asked specifically about some of these defaults. Let's get into that. So I think without actually dissecting each of these individual situations, what I do want to point out is some of the characteristics. And I think if we look at Tricolor and First Brands, what happened is that these were extremely complicated situations where they were doing a lot of off-balance sheet financing like SPVs. What it felt like is very Enron-esque, and for someone who actually worked at Enron many, many years ago, a different lifetime, me, it looked very similar to that, where it was a very complicated debt structure. They had both public debt as well as private debt, and they were taking pools of collateral and over-collateralizing it with debt. So essentially, taking one public and saying, hey, it's tied to this asset pool, but then also on the private using that same asset pool. And so it became very wonky. And ultimately, not to say that it was going to happen, but it felt like this was fraught with the ability to have this sort of fraud or default because of how complicated the structure was. And it's not what traditional private lending is. So that's what I would say to put everything in context.
Yeah, that makes a lot of sense. So, in conversations with our managers, maybe about these situations, but certainly the general sense of private credit as a whole market, what are they saying? What are they hearing? What are they seeing?
Yeah. So the first thing that I want to point out, and just to get everybody, cool down a bit, is that when we talk to our managers, the first thing they told us is, hey, we don't have any of this exposure, right? For all the reasons that we just talked about, which is, hey, very complicated situations. Most of this is asset-backed, which is not what these managers are doing. They were doing a mix of both public and private. And then we said, all right, well, let's talk about why we weren't involved and really more about like how you're doing your underwriting. And in effect, we kind of went back through these managers and we're like, your process again, let's talk about it. And ultimately, we became more comfortable with the fact that like the reason why we selected the Blue Owls and the Golubs of the world is their underwriting process, the way they looked at the world so pragmatically. And really, that's what we have to rely on, right? Because we're trying to find really good managers, but those managers have to have a really good process, a really defined process. And they looked at it and they said, yep, we saw these situations and there was no way in heck we were going to get involved in these because we couldn't understand it. It was too opaque. And we said, that sounds great. And they're like, they brought it back to the deals that they do, which is, hey, when we do a deal, like we are the only debt capital. There is no other debt allowed in the structure. If it is, it's going to be much more junior to what we're doing. But in most cases, we don't even allow it. Those are part of those covenants. And we're like, that's fantastic. Again, but that's not to suggest that like defaults won't happen or you won't have any technical defaults. Because if you look at like a Blue Owl and a Golub that are running at multi-billion-dollar funds, like there is a possibility that defaults will occur, and they're working through some right now. And in fact, like they stratify their loan book to say like, hey, these are the pools of assets that are doing exceptionally well. These are the ones that are working as expected, and these are the ones that are kind of the problem children. And we, as you know, we just had a call yesterday with a manager where we're talking about those, saying like, we understand the good ones are working. Let's talk about the ones that aren't. And they know this, and this is the way they stratify their book, and they want to understand it. Now, I think the last thing from our perspective, so we can mitigate risk by the managers that we select, but more importantly, how are we trying to mitigate this sort of risk from our clients? And this is where we're going to sound like a broken record, right? It's diversification, right? How do we protect capital in equity markets? Is it to concentrate into the top 10 tech stocks in the US market? No, it's to buy a basket of US stocks. Well, bringing it back to private debt, how do we do that? Well, we try and find managers that have well-diversified books of loans already, but then we want to pair those with others such that they're doing something different. So like the Blue Owls of the world are doing the mega deals. We've got the Golubs of the world that are doing kind of the middle market. We're exploring one that does even smaller loans. And then we're adding other asset classes on the private lending side, like real assets, whether it's real estate or asset-backed, and trying to mix those all together such that we have a diversified pool. And so when you have a First Brands, even if we had exposure to it, it's probably going to be basis points. So even if you wrote it to zero, which you may not need to, it's not going to have the impact on the overall portfolio because that's not what we're trying to do. We want to get the asset class exposure and generate good rates of return based on what's available on the private lending side. Yep.
All right, well, thank you for joining us again for another Barside Chat. I'm Isaac Thompson along with our CIO, Matt Jakimiak, and look forward to seeing you next quarter.
Thanks, guys.